Hello, my name is Fabian Degen. I'm the owner of FMD Wealth Advisors. This is my podcast, Don't Screw Up Divorce. I'm a certified financial planner, chartered financial analyst, enrolled agent with the IRS, certified divorce financial analyst, and certified Quattro specialist. So we are not attorneys and we do not provide legal advice. So anything that is being said should not be considered legal advice by any means. Please consult with your attorney with regard to your legal questions. I help people that are going through major life transitions like divorce. So I'm supporting my clients before, during, and after divorce, and I work with clients nationwide. If you would like my help, click the link in the show notes or visit fmdwealth.com to schedule a call with me. We are open for business. So let's focus on this week's topic: why two households can cost up to 1.8 times more than one. The post-divorce math most couples underestimate. That's the headline for this week's podcast. So one of the quieter realities of a divorce is how dramatically the household budget changes the moment two people start running two homes instead of one. Most high-income families build a lifestyle around the assumption of two adults sharing a roof. The mortgage is sized to the joint income. The school tuition is set by the household's standard of living. The vacations, the cars, the staff, the discretionary spending, all of it is calibrated to the combined picture. So now, when the household separates, that combined picture does not simply split in two. It rearranges, and the new shape is almost always more expensive per person than the old one. For people coming out of a long marriage, this is one of the most emotionally and financially disorienting parts of the experience. The income on paper has not changed. The numbers on the settlement look reasonable. But the day-to-day reality of running two households at anything close to the previous standard is meaningfully different and almost always tighter. So planning for that reality in advance and with the clear eyes is one of the most important pieces of post-divorce financial work. So let's talk about why two households cost more than 1.5 times. The intuitive expectation is that splitting a household will produce two households that together cost about 1.5 times the original. In practice, however, the combined total is usually closer to 1.6 to 1.8 times the original, sometimes even more. The reason is duplicated overhead. For example, property tax, insurance, utility, internet, maintenance, and the basic infrastructure of running a home do not scale down with the number of occupants. Each new household adds a full set of fixed costs. On top of that, divorce often happens at the moment when both spouses are reluctant to scale back visibly. Children expect to keep their routines. Both spouses may want to live in the same school district. Neither wants to feel like they are downgrading. The result is two homes that together cost more than the original with the same total income to support them. The arithmetic is unforgiving, and it does not yield to good intention. So let's focus on the standard of living expenses. So in a divorce, the standard of living the parties enjoyed during the marriage is one of the most heavily weighted factors in the maintenance analysis under New York Domestic Relationships Law 236. New York courts repeatedly emphasizes that neither spouse should have to spend down assets to maintain a reasonable approximation of the marital lifestyle. But the courts also recognize that two households cannot indefinitely maintain the same lifestyle as one. There's no formula that produces two parallel marital lifestyles on the same income. It just doesn't exist. What that means in practice is that the standard of living analysis is a negotiation about how to allocate the shortfall, not a question of how to preserve the prior lifestyle in full. Again, it means the standard of living analysis is a negotiation about how to allocate the shortfall. That's important to understand. You're allocating the shortfall. So approaching the conversation with that understanding helps. Both spouses come into negotiations expecting to maintain their prior lifestyle, and both leave the negotiation having accepted some adjustments. The question is, which adjustments make sense for which household? So let's talk about the projection. So here's what you should make sure. Project the real numbers before you settle. The single most important piece of financial work in the months before settlement is a detailed projection of post-divorce expenses for each household. Not a rough estimate, not a back of the envelope number. A line by projection of every category of spending with explicit assumptions about housing, transportation, children, healthcare, taxes, debt services, and discretionary expenses. This work serves two purposes. First, it gives you a realistic sense of what you actually need each month and what you can afford to give up. Second, it gives you and your attorney a documentary basis for the standard of living analysis and the support negotiation. Households that go into a divorce without this projection tends to negotiate from emotions. Households that have done the work tend to negotiate from numbers, and they almost always do better. So, where can you look for real adjustments? So the categories that yield the most flexibility post-divorce vary by family, but a few patterns recur. Housing is usually the single largest variable. The marital home is often more home than either spouse needs going forward. And the cost of carrying the home, so for example, mortgages, taxes, insurance, maintenance, is often much higher as a share of post-divorce cash flow than it was of a pre-divorce cash flow. So selling or refinancing the marital home is one of the most consequential lifestyle decisions in a divorce. Discretionary categories like dining, travel, hobbies, entertainment usually offer real flexibility without dramatic visible change. So these categories can absorb meaningful adjustments without disrupting the children's routines. Categories that look fixed often are not on closer inspections. So for example, subscription services, household services, automobile choices, and insurance coverage can all be reviewed and tightened. Tuition and child-related expenses are usually the categories families are least willing to adjust, and the support agreement typically anchors these. They are often the last line item to be reconsidered, sometimes well after the divorce is complete. So what should you watch for? What should you be on the lookout for? You should be on the lookout for the cash flow. The cash flow is the real number to watch. Net worth is the headline number in a divorce. Cash flow is the number that determines daily life. So for example, a spouse who walks away with 5 million in retirement accounts and paid off the full house can still feel financially tight if their monthly cash flow does not support their fixed obligations. A spouse with less worth but stronger cash flow can feel more financially secure in the short and medium term. After the divorce is final, the most useful financial tool is a clean monthly cash flow statement. So what does that mean? Income from all sources, expenses by categories, surplus or shortfall. Reviewing it monthly for the first year and quarterly afterwards makes early problems visible while they are still small. Where the cash flow does not match the lifestyle, the choices are limited but clear. Increase the income, reduce expenses, or draw on assets. Each of those choices has trade-offs, and the right combination is a financial planning conversation, not just a budgeting one. So let's talk about the first year after the divorce. So the first year in general is the hardest. Almost everyone who goes through divorce describes the first year afterwards as the hardest financially and emotionally. Part of that is work of setting up a new household. So deposits, furniture, services, the dozens of small expenses that come with starting fresh. Part of it is the time lag between the financial picture you were used to and the one you are now operating in. Part of it is sheer exhaustion from the case itself. So builds and rebuilds rarely happen smoothly. There will be unexpected expenses. There will be moments where the difference between your earlier life and your current life feels massive. This is normal. It is also temporary. Households that get through the first year with a clear financial plan and a cash flow they understand almost always stabilize. Whereas households that do not develop that plan often spend the second year fixing problems that were created in the first. So make sure you build the new life on real numbers. So the lifestyle conversation in a divorce is one of the few areas where both spouses' interests generally align. Both households need to be financially viable. Both spouses benefit from a settlement that produces a stable rather than a stretched outcome on the other side. Getting there requires putting the numbers on paper, looking at them clearly, and making explicit choices about what is preserved and what is adjusted. None of that work is dramatic, and very little of it is what people imagine divorce planning to be. But it is what makes the difference between coming out of a divorce financially intact and coming out of it with a settlement that quietly does not work. The math is unforgiving. With the right preparation, it does not have to be unmanageable. Let's focus on some frequently asked questions that I receive from my clients. How do I figure out what my post-divorce expenses will really be? Start by categorizing the last 12 to 24 months of joint spending, line by line. Then build a projection for each future household, adjusting categories that will change. For example, housing, vehicles, dining, travel, and noting the new household-specific expenses. The first projection is rarely accurate, but it gives you a baseline to refine. A certified divorce financial analyst can help build this projection in a structured way and stress test it under different scenarios. Next question. Should I keep the marital home if I can afford it? Well, maybe, but the answer is often less obvious than it feels. The marital home carries emotional weight, particularly when children are involved. But it also locks up capital, requires ongoing carrying costs, and is illiquid. Many post-divorce households are better served by a different home or by renting for a transitional period. Run the math on what the home costs to keep versus what selling and rehousing would free up. Then decide with both factors in view. Next question. When should we tell the children about lifestyle changes? Well, practically, timing varies by family, but the general principle is that children adjust better to changes that are explained calmly and in advance than to changes that appear suddenly. If a move or school change or a significant lifestyle adjustment is coming, age-appropriate conversations well before the change is almost always better than waiting. A child or family therapist can help structure those conversations. So, next question. What is the single most useful tool for the first year post-divorce? I think a simple monthly cash flow statement reviewed every month. Not a complex budget, not a long-term plan, just a clear picture of what is coming in, what is going out, and what is left. Small problems show up early. So categories that are running over their projections become visible while there is still time to adjust. By the end of the first year, the statement turns into a stable foundation for long-term planning. This was this week's podcast, Don't Screw Up Divorce. My name is Fabian Degen. I'm the owner of FMD Wealth Advisors. I am a certified financial planner, chartered financial analyst, enrolled agent with the IRS, certified divorce financial analyst, and certified collateral specialist. We are not attorneys and we do not provide legal advice. Anything that is being said should not be considered legal advice by any means. My company helps people that are going through major life transitions like divorce. I'm supporting my clients before, during, and after the divorce, and I work with clients nationwide. If you would like my help, click the link in the show notes or visit fmdwealth.com to schedule a call with me. We are open for business.